Max Friedrich is a digital wallets and payments analyst at ARK Invest. We've got Tom White here in studio with us. He's going to do some trading, but first let's talk fundamentals. So Max, it seems like everyone wants a piece of consumer spend. That's kind of the Occam's razor for at least my answer for why they're doing it, but to what extent can they really get involved?
Yeah, for sure. Thanks for having me. So we saw these announcements really over the last months, right? We had Facebook's Libra announcement a couple of weeks back. Now we heard Google and Facebook last week. I think what you have to think about kind of on a global scale is that, especially in developing countries, large companies with large user bases, such as, WeChat in China, you can look at a Grab in Southeast Asia. These companies all around the globe want to level their customer base. And I think that's also what we now see in the developing world. Of course, like I said, with Facebook's Libra, that faced some challenges, so maybe they want to take a second run with it with Facebook Pay, and a lot of people are talking about these existing user bases of names like Facebook, right? And that for sure is correct. But I think from our perspective, of course, there are very interesting opportunities if you think about remittances on WhatsApp, if you think about Instagram checkout. But these users are not just going to come by themselves. So, they have to incentivize their global user base to actually get on these platforms. If they're able to do it, great. But there still is a challenge, right? WeChat also had to do these red envelope campaigns to get everybody hooked on WeChat Pay. So this is not kind of a directly like a national movement. And then, of course, you have other competition. You have the Cash App from Square, of course, and you have PayPal's Venmo here in the US. You have a bunch of challenger banks. You have existing fintech companies like SoFi also getting into the kind of checking account business. So there really is competition coming from every angle.
For Facebook, first, the obviously company is one of the most highly scrutinized by legislators right now. Libra didn't do them any favors in that realm. But that being said, on the other hand, it does seem like it's one of those that makes the most sense, given that there's going to be a lot of commerce happening on the likes of Instagram, as you mentioned. The idea that their messaging services could incorporate a Venmo-style, payment service. So is that going to? How do we sort of weigh that? Right. On the one hand, there's already huge amounts of scrutiny on Facebook legally. On the other, seems like it makes really reasonable sense.
Yeah, you got a point there. What you have to remember, though, is that Facebook did messenger payments, kind of these peer-to-peer payments, since really for years now, right? So we had David Marcus joining them in, I think it was 2012 from PayPal, and everybody kind of expected the big Facebook payment push. That didn't really come, and like I said, you had the peer-to-peer payments on Messenger, which, in our opinion, didn't really take off. So they actually discontinued them in France and the UK earlier this year. Right. We really have to see about that. I think the interesting areas about Facebook is really WhatsApp, right? So they've been trying to push WhatsApp Pay in India, also had some struggles over there with local regulation. But if you think about WhatsApp, right, a huge global user base, especially in developing countries. If you think again about remittances, that could be very interesting. And then, of course, you also just mentioned it, Instagram, right? So they launched Instagram checkout with the help of PayPal earlier this year. If you think about that, keeping the kind of the order flow and the payments flow within the Instagram app, that could be an interesting opportunity, right? Placing Facebook Pay, very prominently. Maybe it's going to be even the only checkout option there. So that could be interesting. On that front, what you have to keep in mind is that they are doing this Instagram checkout feature with right now only about a couple of dozens big brands like H&M and others. So the success of Facebook Pay in terms of Instagram, in our view, is really going to depend on how well they can kind of expand the Instagram checkout features also to smaller brands and really leverage Facebook Pay really across Instagram, also on these smaller accounts.
So there's going to be obviously a lot of work they have to put into this. Which companies on the tech side right now are the most tied from an investment standpoint to payments? I mean, is it just the stuff that's already been working, Visa, MasterCard, treating them as tech companies, or does that story have any real bottom line impact right now for the likes of Alphabet, maybe Apple that's got the card?
Sure. I think what a lot of people are talking about in regards to Facebook and peer-to-peer payments and so on is Venmo and Cash App, so that are the digital wallets of PayPal and Square, respectively. So we actually had a little research project this summer where we scraped the public Venmo API. And what we found there is that the users are actually very sticky in these payment networks, in these peer-to-peer payment networks on Venmo, and we think on Cash App as well. So what we saw positive churn rates, even after years, really, of these customers being on the platform. They came back to the platform, right? So imagine, you download Venmo when you're in college, and then, you go off, you have a job, a couple of years later, you have a babysitter. Now the babysitter only takes Venmo, so all of a sudden you're back on Venmo, right? So it's very sticky, these peer-to-peer payment networks. So if a user really is on them, we think that it's hard for a Facebook or even a Google to kind of disrupt that relationship.
Right.
Just one quick note on Google. Google is actually pretty interesting. They've been pushing really hard on the AI front lately. So in terms of natural language processing, they put out this, or they're now working with a technology which they call BERT, a neural network, natural language processing technology that is really good at reading search results. So we think that this technology could even be kind of, could seem in the same context as their checking account announcement. If you think about it, if Google gets even better and better at reading your search results, it might even get better than, let's say, the third party that they would normally redirect you to, right, a kayak or something. Mm-hmm. So you would potentially be able to find better deals directly on Google because, like I said, they're getting better at search and scraping the web. Yeah. So having Google checking account, could even make sense from a consumer perspective, where in a couple of years you would actually buy products directly on Google.
Sure. Hey, well, they're already putting major problems in for Trip and all the other booking companies, so why not do it for payments as part of it? Max Friedrich, really good stuff, joining us from ARK Invest. Thank you, sir. We're going to trade it now. The point about stickiness, I think, is really important that Max makes, right? So for me, that brings us to PayPal, okay? Which is obviously owner of Venmo. That means if you've got a bunch of people on Venmo, to Max's point, no matter how many tech companies try and come after them, people stick with what they know.
They do. They are sticky. And, on the last earnings report, part of PayPal's results was based on the fact that, hey, Venmo is driving them forward, moving them forward. The clients are sticky. Yeah. Shares are up about 21%, 22% this year. So underperforming the overall market and especially that sector. But what I looked at was using options to take advantage of maybe a move higher over maybe a couple months period time. And I looked in the January cycle, Oliver, where I'm buying a call vertical that's currently at the money. So you buy the January 103 calls, sell the 110 calls to reduce your costs on that. But then to finance the buy of the call spread, I looked at selling a put spread here, and the 100 level has been a big area of support for the stock. So I'm selling the 100 puts in the January cycle, buying the 95s because I want to stay risk defined in case we do get a pullback in the overall market or in this name. You're basically paying about 75-cent debit. Now, that's probably a little bit higher because the stock's up a little bit today. But if you pay 75-cent debit on this, you get a break even of 103.75 to the upside. Mm-hmm. So basically just a few pennies higher from where the current share price is. So you get to take advantage of the upside, Oliver, but you limit yourself on the downside. If it does stay above 100 and it doesn't get above that 103.75, you just your net risk on that's only about the 75-cent debit. So it's a way to take advantage of the upside while also keeping yourself risk defined on the downside, which is what you want in case the shares do start to slide.
Okay, now on the other hand, one of the names we've seen in tech that has moved first in this space has been Apple. Yep. Apple's obviously gone on a huge run. Yeah. Who knows how to separate what cause from catalyst from price, but just real quick, how do you think about Apple at this point?
Well, if you look at it, what's worked for Apple this year in the options time frame? Mm-hmm. Selling puts, right? Okay. Selling cash secured puts has been a systematic option strategy that's worked out well for this company because it's up 67% year to date. But That being said, with it at or near all-time highs, especially on this rally, we're up above 264 at this point right now. I just looked at D's, and I went out about 25 days to expiration, looking at selling a put spread instead of just a cash secured put. Because it's at lofty levels, it's getting a little bit overbought on a technical level. I want to protect against any downside, but I still want to take that bias that it's going to remain above maybe 255. So I looked at the actual trade that we were going to look at is 255, 250 put spread for $1.15 credit. Now, you're not going to collect that much because the stock has gone up since I created this one example trade. Okay. But this is a whole idea. You sell some puts or put verticals that are about 60 to 70% probabilities that it's going to finish out of the money at expiration. You sell those on a month-to-month or week-to-week basis. You collect credits on those if you believe, or if your assumption as an investor or trader is that it's going to continue to move higher or at least not pull back. This is a strategy to take advantage of that. Stay risk-defined, though, especially with it at these levels.
All right, I like it. Tom White, nice work. Max Friedrich joining us from ARK Invest. Nice work, guys.